With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and microcap data place. Welcome to the virtual Roadshow series presented by ChannelChek. This Roadshow features Darren Jamison, President and CEO, and Eric Henchken, CFO of Capstone Green Energy Corporation, NASDAQ ticker symbol CGRN. Following a formal presentation, they're joined by Michael Heim, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed SEC-registered broker-dealer, for a Q&A session featuring questions that were submitted by the live audience. You can find Noble's research on Capstone Green Energy Corporation on channelchek.com or by clicking the link in the description. With that, I am pleased to present Darren and Eric.
Thank you. Good afternoon, everybody. Darren Jamison, CEO of Capstone Green Energy. Do a quick business overview, and then we'll move into some of the financials, and then do a quick summary on why investing in Capstone Green Energy today, and then open up to some Q&A. So if you look at today's world, and especially in the energy space, it's changing, and it's changing quite quickly. You've got the Gen Zs, which comprise about 1/3 of the world's population. According to most studies, they're willing to pay 50 to 100% more for sustainable products. You've got 73% of consumers, according to a Nielsen study, that said they would likely change their behavior to reduce their impact on the environment. Another recent study said that sustainability is the second highest reason most consumers return to a brand. And so when we talk to customers today, we're finding customers that are setting up chief sustainability officers. We're finding customers that care about ESG, looking at improving their ESG scores, whether that's oil and gas or whether that's in the industrial sector. Or they're just looking to be greener, and whether it's green building, lower their carbon footprint. A lot of customers are coming to us today saying they want to be carbon neutral by 2030. They don't necessarily know how to get there or what that means. And so that's part of what's behind the change we've made in our business. We are changing basically because the climate is changing and our customers are changing. And so Capstone Turbine became Capstone Green Energy. I'll talk about some of the changes we've made to react to the market and be more of a solution sales provider to our customers. So Capstone was traditionally a product company, and originally primarily in the oil and gas space. So we've been shifting into the energy efficiency space over the last several years, as well as developing an energy as a service business model. But as we started a direct sales organization, we came to realize a lot of customers are grappling with ESG, they're grappling with carbon footprint, they're looking at green building, they're trying to find ways to smartly reduce their energy costs and also lower their carbon footprint. And so we realized we needed even more solutions and more services to offer to them. And so we went through this transition. We publicly announced it on Earth Day, April 22nd. And so this is what the company looks like today. And so Capstone Turbine became Capstone Green Energy. So we still have our energy as a service business, and that's really our most important business for a lot of ways. That leads to long-term recurring revenue, to high margin revenue. That gives us a great foundation from which to build the business. We started with that business really with our long-term service contracts. We call them Factory Protection Plan, or FPP. We're pushing $80 million in long-term FPP contracts. The margin rates in those contracts are in the 40% range today. We've got clear line of sight to 50% as we move through some historical issues we've had with a bad vendor. Long-term rentals are kind of the newer portion of this business. We're very excited about the long-term rental program. We've got Goldman Sachs as our partner backing up the capital costs of that program. So very excited about that, as well as with Goldman. The reason we're excited is one, it's a great way to penetrate a new customer. It's an easier sale than a traditional equipment sale. It's a faster sale than a traditional equipment sale. More importantly, we see about 65 to 70% margin, 30% IRR. So it is capital intensive business, but it's a great recurring revenue, high margin business. When you combine that with our traditional service and spare parts, energy as a service is approximately 40 to 45% of our quarterly revenue or annual revenue today, at very good margins and growing. And so as we continue to add the FPP contracts, we continue to add those long-term rentals. We just announced 3 new contracts last week. We're very excited about where this business is going to go. And our goal for this group, for the energy as a service, is to cover our OPEX. When our reoccurring high margin revenue covers all of our OPEX, which we have line of sight to today, then any product we ship goes straight to the bottom line. This really separates us from the fuel cell companies that have much higher revenues, product revenues, but have terrible service businesses and don't have an energy as a service business model that works. We do. And so we're going to be profitable much quicker than them at dramatically lower revenue levels. As we grow revenue, which is very important for us, we're going to be a much more profitable green energy company. If we move over to energy conversion technologies, or ECT, that has traditionally been our Capstone microturbines. We've shipped over 10,000 microturbines in 83 countries, but we were leaving opportunities on the table. And some customers, we could help them with certain parts of their electrical and thermal loads, but not all of them. So we added 2 more pieces to our energy conversion business line, and that's our hybrid solutions. This is an engine-based instead of turbine-based DC-powered product. And so this is great for peak shaving, remote applications, for combining with solar, potentially wind, battery storage. This is a company we work with. We're building the product under license. They've built hundreds of these around the world in multiple markets. Very proven technology, and we're very excited to be building these under license. Then we also turned to Baker Hughes. We selected Baker Hughes as kind of our large turbine supplier. We selected Baker Hughes because they've got low emissions, they have very long maintenance intervals, they're working on a hydrogen program, and so for many ways, they mirror a lot of the things that Capstone is all about. And so we are a Baker Hughes reseller for the US market, and we're talking to them about other geographies as well. So that gives us an opportunity from a 5 megawatt to 16 megawatt turbine. One Baker Hughes project a year will raise our revenue, 10 to 15% per year. Obviously, same thing on the hybrid solutions, opens up whole new markets for us. So that's great. And so we've got great energy as a service business model. We've added to our energy conversion devices, making both thermal energy and electricity for our customers, all very green. But then we still needed some battery storage to really round out to the microgrids. So we gave some battery storage and thermal storage solutions, as well as microgrid controllers. And so that's a new energy storage solution group. We're very excited about adding that to our portfolio and really providing customers a custom solution, not an off-the-rack solution. And then the fourth business line is a new growing business line for us, our hydrogen and sustainable products. I'll talk a little bit more about hydrogen in a few minutes, but hydrogen is really the future of the energy economy worldwide. And you can hear a lot about hydrogen going forward. You're going to see a lot of investments by governments and the private sector to get hydrogen cleaner and greener. Green hydrogen at a good cost is really what it takes for driving this forward in the future. So we really look to be long-term partners with our customers. And so we felt that way at Capstone Turbine, but Capstone Green Energy is really doubling down on that. And so we're looking at ways to reduce the carbon footprint for our customers and also their costs. And so as this slide shows, we've reduced almost $750 million of energy costs for our customers the last several years and over 1 million tons of carbon. So that's huge, and we can do more. And obviously these new products and the new company will do that even more and do it faster. Why microgrids? You can see from this slide here, microgrid growth is projected to be extremely huge. And so I think as we go forward from 2020 up to 2029, North America is going to be great, but especially Asia, Pacific, and Latin America. So those are areas we've already got good penetration and hope to do a lot more. We've got newer distributors coming online, and you're seeing projects every day in those markets for us. And so as we continue to grow in those markets, microgrids make more sense for us. And so adding battery storage, adding thermal storage, adding controls, adding solar to what we're doing, just to give a customer, again, a complete, special tailored solution. So we added a direct sales organization. There's been a lot of confusion with this, especially with our own distributors. They're thinking that our goal is to take projects away from our distributors and try to claw back margin. Couldn't be further from the truth. What our goal for the direct sales organization is introducing these new products and services to our channel to market, helping educate them on how to sell and service and install those products and services. But more importantly, to go to some of our wins that our distributors have had. So like DHL in New York, or Firestone, or all the Kinder Morgan projects, Mohawk down in Tennessee, multiple Hilton locations, and a lot of the oil and gas folks that we've had great relationships with. But how to go take those singles and turn them into doubles, triples, and home runs. So we're talking to DHL at a North American presidential level. We're trying to talk to most of these customers at a C level as we can. And the goal is to take what was a 1 or 2 project sale by a distributor and make it a wide-scale rollout at a factory level. Wide-scale rollouts and major adoption by any one of these customers on this page would be good for all of our distributors and for everybody. Distributors will still be doing all the FPP service contracts, helping with installation, and many times being at the job walks and at the table with us. And so again, the goal is not to cut the distributor out, but to augment and to accent what they've already done, and obviously drive a lot more top-line revenue and revenue growth for everybody. I won't spend a lot of time on this slide. We've been showing it for quite a while, but basically we got the new direct sales team. We started right before COVID. They're now back on airplanes and doing all the things that the direct sales team should be doing. And again, they're focused on the new microgrid products, the rentals, and those large customers I talked about. Obviously, we're working hard on improving our customer satisfaction. We got a $5 million settlement at the end of last year to replace a bad part we had in the field. That part was really hindering us from getting repeat customers. And so if you think about going through no repeat customers and a pandemic and still end up with revenue that's essentially flat year over year, I think that was a pretty good outcome. We'll come up with some new target pricing for these national accounts. We try to do larger scale rollouts. The new Gold Key Account program is one we're offering to many of our customers today and hope to get a few announced here shortly. New geographies, Eastern Europe, Africa, Middle East. We've got new distributors in place. We've done a great job on the digital marketing side and trying to leverage our unique relationship we have with IndyCar and all the customers we're getting there. And then hydrogen, which I'll talk about here in a second, which is key to our future growth. So I think the short version of hydrogen, you're going to hear about a lot about it if you haven't already. It is a very clean fuel. It's a very abundant fuel. Really the issue is getting it for the right price. And so as countries and governments and industries look to reduce the price, especially of green hydrogen, that's going to drive more adoption. Our technology is currently running on 10% hydrogen, 90% natural gas mix. We've got a stated goal to get to 30% hydrogen, 70% natural mix by March 31st. We think that's going to cover all the near-term opportunities just because the price of green hydrogen is so high. It's 8 to 9 times the price of natural gas. So blending 30% in, getting some of that carbon savings, but then still making it cost effective so you have a reasonable economic return makes sense. As the cost comes down, you'll see more 100% hydrogen projects, and we'll move into our 100% hydrogen technology in the next few years to make sure we're ready for that. We're also working with B+K and 24/7 Solar on zero emission applications of our technology. So I'll turn it over to Eric. We're going to go through some financial review. Obviously, we just ended our March, we just announced our March year end and are just a couple days away from finishing our first quarter.
Yeah. So Darren mentioned we're a March 31st year end. Earlier in June, we announced our Q4 results and we filed our 10K with the SEC. We had a great fiscal 21 despite COVID. A lot of firsts. We had 1.7 million cash generated from operating activities, which was the most in company history. And that included a $5 million settlement we got from a supplier for a bad part. Revenue, Darren mentioned, was flat. We think that's a win, given we were impacted by the pandemic. A lot of our customers are hospitals. We sell into hospitality and industrials as well. They were all impacted by COVID. We announced back in June of last year that we were going to improve adjusted EBITDA by $10 million year over year. We improved by $9,250,000, so we reached, we're at 92.5% of that goal. So again, another win for the year. And then liquidity was key. So not only do we generate cash from operations, we also upsized our Goldman Sachs note by 20 million. So it went from 30 to 20 and at a reduced interest rate. Now, part of that money is going to be used to build the rental fleet from 10 megawatts to 21 megawatts. We also used our at-the-market facility. We brought in $14.5 million in January, and I already mentioned we had the $5 million legal settlement. I'll skip over this, and I'll go to the as-if pro forma P&L. So Darren mentioned energy as a service earlier. What we're showing here is in fiscal 14, when the company was very heavily weighted towards product revenue. We were at our highest revenue level in fiscal 14, 133 million, but we were losing money. So we were negative $11 million adjusted EBITDA. What we wanted to show here is if we get back to those revenue levels, we're showing 134 million here at today's mix of product and higher margin energy as a service revenue, what we'd look like. you can see we'd be at 11 million positive adjusted EBITDA. Right now, our product margins are at 0 because we don't have enough volume to offset the overhead costs. Our accessories, parts, and service are just generating 40% margins. Then some select balance sheet and cash flow items here. Again, liquidity was key during fiscal 21. We ended March 31st, 2020 with $15 million of cash, and we ended with $49.5 million on March 31st, 2021. We did that, as I mentioned earlier, upsizing the Goldman Sachs note, using the at-the-market facility. We had the legal settlement, and we also managed working capital. I'll point out here down towards the bottom, total inventories went from 23 million March 31st, 2020 down to 14 million at March 31st, 2021. And I'll turn it back over to Darren.
Thank you, Eric. So kind of last slide here before we open to questions. What the business catalyst for Capstone? Why invest in Capstone Green Energy now? Obviously, as I opened the presentation today, the world is changing. The move toward sustainability, greener products, ESG, carbon neutrality. I think everybody is moving in that direction. They see it's the right reason, the thing to do for the right reason. I think the new strategic business that we've created with Capstone Green Energy gives us a much larger TAM, and so that's helping us have better conversations with better customers. We may end up selling them some of our traditional solutions, but at least be able to have the dialogue about the different opportunities and see what the right custom fit is for our solutions to meet the goals of our customers. The margin expansion of the EAS business is going to be the driver. That's going to be the foundation, the bedrock of our business. We've been building it for quite a while. You're going to see in the next year to even 18 months how important that business is and how that's going to give us sustained profitability and positive cash flow every quarter in, quarter out. Long-term rentals, I can't wait to show 20, 25 megawatts of long-term rentals quarter in and quarter out and show what that does for our business and our energy as a service. We had good book to build the last 4 quarters. I think this next year we want to continue to build on that. I think we want to see product revenue go up as we still build the energy as a service business. The pandemic and the vendor quality constraints definitely are improving. The U.S. though is much more positive on the pandemic, and we're seeing this real time. Australia just shut down recently. We're still seeing problems in Canada, problems in Brazil. India has been really slow to come back online. Parts of Europe have been slow to come back online, Italy specifically. And so we're much further ahead here in the U.S. than we are in other parts of the world. But I do think everybody is getting vaccinated at reasonable levels. And definitely I think the back half of this year is going to be very exciting. I think the first 2 quarters will still be a little impacted by both the pandemic and the parts issue, but Q3 and Q4 for us should be very exciting quarters. If I look at direct sales team, very happy with what they've done, the amount of opportunities they've generated, and the pipeline that they're putting together. We'll keep adding to that direct sales force. We'll probably try to double it over this year. If they can add 15 to 20% top line revenue growth on top of what our distributors are doing, that'll be excellent. And then obviously we want to keep going from there, do it year in and year out. If you look at, we just did an equity raise a couple weeks ago. We closed it last Tuesday. That's one of the first times we've been able to raise equity that was really growth capital, not survival or oxygen capital, I like to call it. And so it was a fairly small raise compared to what we've seen of people in our space, where people are raising anywhere from 100 million to almost $1 billion in some cases. It was very, very modest, but we're doing it for growth capital. We're also doing it because we're looking to reduce the risk that our people are seeing as our balance sheet. And so as we go out to these bigger customers that we showed on the logo suit page, they're looking for a balance sheet, as well as our vendors. We've been pushing our vendors really hard for more extended payment terms, better pricing, and our balance sheet is a constant conversation with them. And then I think we just also announced, and nobody's got a lot of fanfare, but we actually dedicated an executive to find strategic acquisitions or partnerships. So that is a full-time position we created. I took one of the more valued members of our leadership team and put him full-time in doing that. So I think if we can grow at 15 to 20% a year organically, and then add another, call it 20% a year in strategic acquisitions, that's the kind of growth we need on top of the very lean foundation we have in the energy as a service business model. And so I think that makes the next couple of years very exciting if we can execute against the strategy and continue to put the numbers up we think we can put up. And with that, I will turn it back to the Q&A period.
All right, thanks, and thanks for doing this. We've got a good audience here. I'd encourage anybody who wants wants to ask some questions to click on that button and I will read them. But I'll start things off with some questions. Obviously, it's been an exciting 3 months here. You covered a lot of the stuff you've done with the name change to the first hydrogen project announcement. I want to spend a little time talking about the restructuring, essentially adding these 2 new divisions, the energy storage solutions and the hydrogen and sustainable products division. You obviously are very excited about that. Do you think that those could grow to be an equal in importance to the other divisions?
Yeah, I think if you look at just in the short period of time we've been looking at these offerings, we've put together about a $400 million list of potential projects. That's on top of our typical $1.3 billion of distributor normal projects. A lot of our, at least on the storage side, the battery storage side, we're going to a lot of our existing customers where they've already got a Capstone micro-turbine and maybe storage makes sense, or adding some solar PV to go with it and creating a microgrid. So I think there's some inherent customers that we already have that we can sell that product into. But then it really opens up the conversation with folks and say, look, we can do everything from thermal energy, electrical energy, PV, or wind if necessary, as well as battery storage or microgrids. And we'll back it all up with a 15 to 20 year FPP. And so it really opens up the world from a total addressable market standpoint. We can talk to almost any customer anywhere about our solutions. And so and we can do as little or as much as they want. If they want a complete turnkey solution, which we're doing for some customers today, or we continue to just be a equipment supplier, and everything in between. So I think it really opens us up to more of a solution sale, which I think is what our customers want. I think a lot of customers are moving to green energy. There's just so many different voices and products that they're very confused. And so to have somebody they can turn to who's almost an energy expert who will stand behind the product for 20 years and frankly live or die at the performance of their systems, then that's really what they're looking for.
So where are you right now in terms of your ability to do that? You mentioned hiring an M&A executive and you built up the cash position. What can you do right now, or is this more of a longer strategic direction that will require some acquisitions to get it done?
Well, we've got, on the product side, we've got the deal done with Baker Hughes. We're actively quoting those projects today. We've got the deal done to do the licensing agreement on the smaller hybrid solutions. We also have the network provider agreements done on the battery storage side and on the microgrid controller side. And then obviously we're already working on the hydrogen solutions and everything we're doing in that space. So all the building blocks are there. What I'm looking for is on the acquisition side is how do we add more to the portfolio? I think the 4 business lines we set up are a great foundation and a great vehicle that we can keep adding more products and services into those 4 business lines and be even more comprehensive going forward.
Talk to me a little bit more about the hydrogen. It's somewhat of a new area for me. I think of gas turbines as being very quick to fire up and a good peaking type of device. Does that change as you get into hydrogen?
No, I think how we operate, like today we're running in a lab at Argonne National Laboratory, we fire up on natural gas and then blend into the hydrogen. We've gotten as high as 70% hydrogen to 30% natural gas mix. And so I think there's some operational scenarios on how we start and stop the machine and load changes and those kind of things. So we're kind of feeling our way through that. 100% hydrogen has its challenges from a flashback perspective, hydrogen embrittlement. It's obviously a very small molecule. Leaking is an issue. We've got to make sure we pressurize our system much like we do on offshore applications. So I don't think there's anything from an engineering standpoint that's unachievable. It's just good engineering and time to get it done. But I think for us, it's really, I'm more interested in how fast the hydrogen market develops. And so, we're seeing a lot of hydrogen blending opportunities and frankly, having a lot of conversations with customers saying, hey, we'll put in a 10% or 30% blended system today, but we'll look to upgrade it in the future when green hydrogen is frankly affordable.
You had a news announcement today of another micro-turbine agreement with an Australian E&P. As we see the health of the exploration production companies, are you starting to see a lot more interest and activity? Yeah,
it's interesting. It really was slow until oil got over $70 a barrel, and all of a sudden things have started to pick up. I also think the pandemic has hit them hard, and so I think as the recovery from the pandemic and demand starts to increase, you're seeing higher oil prices, and they appear to be sustainable. So this summer should be good for those folks. I think the more green energy we put on the grid, the more expensive the grid's going to become, and so that's going to help those projects get even more competitive. And so I think 30% of our business today has been in the oil and gas space, or in the last fiscal year. I think that's going to continue to grow, and I'm excited about the opportunities, both in new equipment sales like we announced today, as well as on the rental side. We've got a lot going on with Blue Crest, Shell, a lot of our good customers in the oil and gas side on the rental product.
We talked about the cash position building up. How large would you like to get it? Did this last ATM, was this really more opportunistic, or are you really starting to build up in preparation of if you need a stronger balance sheet to bank acquisitions, you'll have it?
Yeah, both, right? I think we raised money on the ATM in the third quarter in about a week. The ATM slowed down, or the volume of the stock slowed down, so we did a more CMPO this last quarter. But I think as the market's good, people have appetite for companies like ours. The deal's traded very well since we got it done. I think part of it is also we want to rebuild our institutional ownership. Back in 2014, 2015, we were 85% institutional, 15% retail. That's flip-flopped to 100%. And so if I can get some institutional longer holders into some of these deals, then that's obviously preferable. But the most important thing is if we do business with big companies, we have to appear like a bigger company than we are. We have to have a balance sheet. People have to be comfortable. If you're going to do a large-scale rollout at DHL or Marriott or Magna, Pickett, doing that with a company that's not quite profitable with a small balance sheet's a big risk, and people in big companies don't like to take big risks.
We talked about the hydrogen. I want to talk a little bit more about the micro-turbines. Help me kind of understand what's the typical customer base that would be. Are we talking about multiple customers working together, or is this more a single customer with multiple units and areas?
Yeah, most of what we're looking for is, it can be both. Almost all of our micro-turbines are sold in arrays. So even a hotel will typically have anywhere from 4 to 12 microturbines, and so we set them up as array, and it gives more reliability that way, more resiliency that way. But what we're looking for is customers that can go do multiple locations. And so if you're a hotel chain and you've got 30 locations in 3 countries, we've done 1 or 2 installations in 2 different countries. We want to say, okay, management, hey, well, let's go do all 30 of them. Give us a target for payback. Give us a target for carbon reduction. Let us go see if we can get all these done at a reasonable price and a reasonable carbon reduction. And so I think having those conversations, obviously customers are uncomfortable with that, but again, as we build more installations, more experience, more hours, that'll get easier and easier. And I think once customers start losing business because their competitors have gone greener, the competitors have installed our technologies, and they're losing, whether it's hotel guests or consumer product loss or buildings, rentals, whatever it may be, that's powerful. And so I think I tell customers, I really don't care what side of the political aisle you're on. If your customers want a sustainable green product, or your investors want you to be ESG, you need to do it, whether you agree with it or not.
We do have one question from the audience. It kind of dovetails off the earlier question that I asked, but it essentially says, what was the logic and the reason for the sale of the 2 million plus shares at a major discount? Diluted the existing shares, as well as an immediate 25% plus hit to the valuation and market cap. Why not take out loans at a lower cost? Yeah,
we've got a $50 million loan with Goldman Sachs already at 8 3/4 plus prime. So we've already got loans in place. I think you can't get so much debt that it smothers your company. I mean, we're already paying $5 million a year in interest expense as it is, and that's down from the prior interest expense. And so until we're generating free cash flow, too much debt is a problem. We did that deal at 5 1/4. When we launched the deal, we're at $6.98. I think we're trading over $6 right now, less than a week later. So I guess I'd probably just push back a little bit on the discount. And part of it is we also had no warrants. And so if you look back at all the deals we've done in the last 10 years, almost all of them have warrant coverage. And so, investors, especially retail investors, all they see is the discount. They don't count those warrants because they may not come in for 5 years, but there's still dilution. They do come in, they're still dilutive. And so for us to move away from, people that are, deal folks that live off the warrants and sell the stock immediately and hurt the company, I think the people that buy into the equity offering are going to hold the position longer and don't require the warrants to get into the deal. That's a positive, but I would not add more debt. I can't have $10 million a year in debt and get this company profitable. So, and again, I think if you look at, I'll put us against any of the fuel cell companies or clean tech folks who have raised anywhere from $100 million to $1 billion in the last, call it 24 months. we've been very, very conservative in the money we bring in. And again, for me, it's how do you spend the money and what do you do with it? If you're bringing in oxygen capital and you're burning it, then that's a problem. If you're bringing it in to reinvest in the business, to build rentals, to do acquisitions, that's good cholesterol versus bad cholesterol. And so I think for us, we went from a $15 million balance sheet to a $50 million balance sheet. We just added another 11.5 million gross. We're trying to be, as prudent as we can be. Obviously, I'm one of the largest shareholders in the company myself, so anytime I do dilute the company, it hurts myself as well as everybody else. I know a lot of folks think that all my shares are free. I've actually bought more in the open market than I've got vested from the company.
You mentioned, I think, on the earnings call about how you were not getting as many questions about your balance sheet as you were going out to customers. How important is a healthy company, a healthy balance sheet in terms of just bringing in business?
Oh, I can't overstate it. I mean, it's the biggest issue. If you're Caterpillar, if you're our competitors, I mean, that's the easiest thing to throw rocks at. To say Capstone's a great little company, interesting technology, but they're not profitable. They're one bad quarter away from being in trouble. If they got a business, who's going to buy them? Where are going to get your parts? It's great if they sign a 20-year FPP, but if they're not in business, then what's the value of that FPP? So that long-term commitment to our product is key, but we have to back that up with a balance sheet, and we have to get profitable. And so our goal is to get as profitable as possible and build the strongest balance sheet we can in a reasonable and professional manner.
We have another question coming in who asks, why are you pausing? I think it meant to be pausing such a high interest rate.
Paying such a high interest rate. Yeah, no, I mean, the interest rate was over 13% when we originally got it. I think a lot of folks don't realize when you're not a profitable company and you try to borrow money, the rates you pay are extremely high. And so we were paying over 13% on a $30 million note with Goldman. We then refinanced to 50 at 8 3/4. And so I think as you need, as everybody knows, as you need the money less, the rate goes down. Bankers will give you all the money in the world if you don't need it at great rates. If you need the money, it's all based on risk. And so when we did the Goldman note, we went out to 12 different lenders, and Goldman actually was the most competitive at 13%. That gives you an idea what it looks like. And so that's where, I called it my payday loan back then. We refinanced it to 50 million again and lowered the interest rate almost in half. And so as we grow the business, as we get profitable, we can refinance Goldman in a year from October, and I'm hoping to do it at a lower rate or pay them off. If we get to the point where we've got enough of our own cash and enough cash flow, we'll pay Goldman off and move on down the road with more traditional financing.
Yeah, I think it's important for people to understand our cash requirements for fiscal 22, this upcoming year. So we had the $5 million settlement from the supplier, but those costs won't hit until fiscal 22 as we go out and repair the bad units in the field. So you've got $5 million of cash used to take care of that. We need to build the rental unit fleet to 21 megawatts to be in compliance with one of the Goldman Sachs covenants. So we're going to spend $8 million building out the rental fleet in fiscal 22. And then we need to service that debt as well, which is about $1.25 million per quarter. So that's another $5 million of cash use. So right there, you've got $18 million of cash use for fiscal 22.
Hey, Eric, is the intent with these new 4 operating divisions to start reporting revenues as 4 different units?
So we already changed the reporting a little bit in the 10K, you'll see, to more align with the new business units. The first 2, the energy as a service and the product. So I think as those units get bigger, then absolutely we would report them separately. But as they're immaterial now, we just report the 2.
Also, as a smaller company, I mean, you can't tell what Caterpillar charges for 3516. You go into our K's and Q's, and you can get a lot of information because we're small. And so in some ways, being a smaller reporting company going up against bigger, larger brands, it's unfair because we end up with a lot more detail out in competitors' hands than what we get back from the competitors because they're so much larger and their reporting structure is so much bigger to try to dissect. So I also get a question all the time, like you do press releases, why don't you say who the customer is? Well, if we haven't shipped the unit yet and I say who the customer is, then I've got 5 competitors calling them up trying to undo my deal. So I know investors want to know what's going on, but we got to do what's smart for us. So we'll talk a lot about case studies, installed units. We'll talk all the time who has the product once it's sold and installed, and we're not worried about customers, being shopped or competitors aggressively trying to undo our deals.
We have another question coming in asking about federal funds or grants available for environmental conservation companies. Maybe just talk a little bit about what the landscape is in terms of tax subsidies, et cetera.
Well, for our customers, obviously they get the 10% investment tax credit here in the U.S. It's been extended multiple times. Fuel cells and wind turbines and other products get 30%, which we've always kind of pushed back against. We don't think the government should pick solutions. If we meet the lowest emission standards in the world, I think we should all be treated equally. And then each state in the U.S. has different reduction programs for energy efficiency. I think, whether it's California, New Jersey, New York, we're seeing more and more of those pop up around the U.S. Obviously, if you go to different countries, they've got different standards for green building, different incentive programs. And so we have a whole group of folks, and that's part of what we do with our distributors, is to go around and look at every market and see what the opportunities are for funding. Obviously, the new Biden administration, we're hopeful, is going to put more out there for green building and probably for hydrogen development. The DOE is already floating multiple programs to try to reduce hydrogen costs, like 80% over the next decade. And so I think we'll see, the infrastructure bill, we thought might have more in it for green energy. It looks like they pulled some of that back out. We'll do a separate bill. But I'm confident that the administration is going to do more to help, grow green building and green energy and hydrogen, and obviously than the previous administration. That being said, a lot of businesses are getting there on their own. They're realizing that if I can lower my carbon footprint, be more sustainable, and save money, then why not? That's not a bad place to go. And again, I think it's going to be driven more by consumers than it is by the government, which is, I think, is a healthier approach.
All right, I'm going to put out one more call for last questions as we get towards the end here. I've got one more from the audience, and it's asking, do you have any desalinization projects? We
do have some desalinization projects. They're smaller ones. We looked at some bigger ones. I think that's an interesting market. I think mining is an interesting market. We've got some opportunities. We are seeing Bitcoin mining operators come to us in greater numbers looking for green energy solutions. I would say probably the most success we've had recently, and probably the last year, in kind of new market, is grow houses. We've done a lot in the cannabis space, both in rentals and in sales. And so I think that's one that I know there's some sensitivity to some folks on that, but for us, they're big energy users and they value resiliency. Most cannabis growers, if they lose power for 12 hours, they lose a crop, which is usually $1 million. And so obviously they want to pay for high quality power and resilient power. So I think that's one we'll see. Breweries have also been doing very well. That's one area we talked about what didn't do well during COVID. Breweries and cannabis definitely did well. So Buds and Suds did well during the pandemic as opposed to hotels and hospitals.
And did I hear you say you expect to double your direct sales force this year?
Yeah, we're up about 6 folks today. We just put an offer out into another one. We've actually set up a sales office, direct sales office across the street on the facility we're renting there. And so we've actually brought back a couple employees that we had furloughed or had left previously. So yeah, we hope to get it up to 10 to 12 people. Obviously, the more we can sell, through the year, kind of help funding that growth, that would be the best way to go.
Thank you for joining us for this virtual roadshow presentation brought to you by ChannelChek. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and micro-cap companies.